I'm recording it.
Political system's ability to act. The markets, on the other hand, continue to believe our credit status is AAA. In fact, Warren Buffett, who knows a thing or two about good investments, said, if there were a quadruple A rating, I'd give the United States that. I and most of the world's investors agree. That doesn't mean we don't have a problem. The fact is, we didn't need a rating agency to tell us that we need a balanced, long-term approach to deficit reduction. That was true last week. That was true last year. That was true the day I took office. And we didn't need a rating agency to tell us that the gridlock in Washington over the last several months has not been constructive, to say the least. We knew from the outset that a prolonged debate over the debt ceiling, a debate where the threat of default was used as a bargaining chip, could do enormous damage to our economy and the world's. That threat, coming after a string of economic disruptions in Europe, Japan, and the Middle East, has now roiled the markets and dampened consumer confidence and slowed the pace of recovery. So all of this is a legitimate source of concern. But here's the good news. Our problems are imminently solvable, and we know what we have to do to solve them. With respect to debt, our problems is not confidence in our credit. The markets continue to reaffirm our credit as among the world's safest. Our challenge is the need to tackle our deficits over the long term. Last week, we reached an agreement that will make historic cuts to defense and domestic spending. But there's not much further we can cut in either of those categories. What we need to do now is combine those spending cuts with two additional steps. Tax reform that will ask those who can afford it to pay their fair share, and modest adjustments to health care programs like Medicare. Making these reforms doesn't require any radical steps. What it does require is common sense and compromise. There are plenty of good ideas about how to achieve long-term deficit reduction that doesn't hamper economic growth right now. Republicans and Democrats on the bipartisan fiscal commission that I set up put forth good proposals. Republicans and Democrats in the Senate's Gang of Six came up with some good proposals. John Boehner and I came up with some good proposals when we came close to agreeing on a grand bargain. So it's not a lack of plans or policies that's the problem here. It's a lack of political will in Washington. It's the insistence on drawing lines in the sand, a refusal to put what's best for the country ahead of self-interest or party or ideology. And that's what we need to change. I realize that after what we just went through, there's some skepticism that Republicans and Democrats on the so-called super committee, this joint committee that's been set up, will be able to reach a compromise. But my hope is that Friday's news will give us a renewed sense of urgency. I intend to present my own recommendations over the coming weeks on how we should proceed. And that committee will have this administration's full cooperation. And I assure you, we will stay on it until we get the job done. Of course, as worrisome as the issues of debt and deficits may be, the most immediate concern of most Americans, and of concern to the marketplace as well, is the issue of jobs and the slow pace of recovery coming out of the worst recession in our lifetimes. And the good news here is that by coming together to deal with the long-term debt challenge, we would have more room to implement key proposals that can get the economy to grow faster. Specifically, we should extend the payroll tax cut as soon as possible so that workers have more money in their paychecks next year and businesses have more customers next year. We should continue to make sure that if you're one of the millions of Americans who's out there looking for a job, you can get the unemployment insurance that your tax dollars contributed to. That will also put money in people's pockets and more customers in stores. In fact, if Congress fails to extend the payroll tax cut and the unemployment insurance benefits that I've called for, it could mean 1 million fewer jobs and 0.5% less growth. This is something we can do immediately, something we can do as soon as Congress gets back. We should also help companies that want to repair our roads and bridges and airports so that thousands of construction workers who've been without a job for the last few years can get a paycheck again. That will also help to spur economic growth. These aren't democratic proposals. These aren't big government proposals. These are all ideas that traditionally Republicans have agreed to countless times in the past. There's no reason we shouldn't act on them now. None. I know we're going through a tough time right now. We've been going through a tough time for the last 2.5 years. I know a lot of people are worried about the future, but here's what I also know. There will always be economic factors that we can't control. Earthquakes, spikes in oil prices, slowdowns in other parts of the world. But how we respond to those tests, that's entirely up to us. Markets will rise and fall, but this is the United States of America. No matter what some agency may say, we've always been and always will be a AAA country. For all of the challenges we face, we continue to have the best universities, some of the most productive workers, the most innovative companies, the most adventurous entrepreneurs on earth. What sets us apart is that we've always not just had the capacity, but also the will to act, the determination to shape our future, the willingness in our democracy to work out our differences in a sensible way, and to move forward, not just for this generation, but for the next generation. And we're going to need to summon that spirit today. The American people have been through so much over the last few years, dealing with the worst recession, the biggest financial crisis since the 1930s. And they've done it with grace. And they're working so hard to raise their families. And all they ask is that we work just as hard here in this town to make their lives a little bit easier. That's not too much to ask. And ultimately, the reason I am so hopeful about our future, the reason I have faith in these United States of America is because of the American people. It's because of their perseverance and their courage and their willingness to shoulder the burdens we face together as one nation. One last thing. There is no one who embodies the qualities that I mentioned more than the men and women of the United States Armed Forces. And this weekend we lost 30 of them when their helicopter crashed during a mission in Afghanistan. And their loss is a stark reminder of the risks that our men and women in uniform take every single day on behalf of their country. Day after day, night after night, they carry out missions like this in the face of enemy fire and grave danger. And in this mission, as in so many others, they were also joined by Afghan troops.
Okay. One thing we understand is that when he was talking, we were going down more. The monthly chart on the S&P 500 index has fallen below its key 100-month moving average. Ever since you had this last rally off of the 2010 lows, we have given up key technical damage, as we have been saying for many months here at StockMarketFunding.com. And that this was inevitable, and that this was going to happen, and that the same kinds of rhetoric, the same kinds of talks have happened repeatedly and time again. Now, at some point, something's going to have to change. And they are furious about the downgrade, but you know, the Standard & Poor's had a due diligence to worldwide economies as to what the downgrade part of the debt would be. But over the last couple years, nothing has been done to fix the problem. The problem was only stimulated. These were the 2009 lows. That was a great rally from the 2008 sell-off, but it's ended up here. We called the short back up here. 1, 2, 3, 4 months we've been selling off. We have a big monthly gap down that started the dog days of August right here on this monthly chart. And the thing about it is that it was showing all the signs from the original rally here to here is where all the stimuluses had came in, you know, buy a clunker, buy a washer, buy a dryer, mortgages, you name it, the TARP fund, all of that stuff. You know, the thing about it is identify when to be out and identify when to get short, be able to learn the key elements of extreme tops and failures within markets that are heavily manipulated and leveraged to the upside. There's a lot more to the story that we have, and we're willing to share it with you, but you have to be willing to live with the truth. And here's the truth on the monthly chart on the S&P and how it was making those tops and how the daily and the weeklies and the price volatility was increasing in the month of the dog days of summer, and that back in March and April we said volatility was going to get to such levels, and the only time that that volatility really gets to these kinds of levels, just like it did in year 2000 and 2008, is when the bigger drop comes and it builds in that volatility. And there was a lot of distribution, but the monthly charts and the technical damage on the S&P 500, oh boy, at some point there'll be great buying opportunities, but right now everything that happened over here and the releveraging process to a new deleveraging process, and 2008 was a great place. That was a short that we enjoyed. And we have lots of commentary about all of these things that were going to take place and why. And when we put the tops in 2007, this was a top that was put in here on the monthly, because it was. And you can see it. The reversal here, you can see how reversal started over here, and then how the reversals went straight down. You can also see it in year 2000 here. Once again, there are consequences to be paid. That every one of these expansions, as I've always said, they always end up in a bad way. Why is that? Because they were never done right. Yes, you get great bull rallies and you get great bear rallies. And you have to know how to go through it, wade through it. But right now, I am below the monthly averages here, right here. You can see the 10-month. You gap down here to the 100-month. You gap down to the 50-month. The 40-month is going to be right here. And learning the mathematical equations in moving monthly moving averages and weekly moving averages, how they build strength in rallies, but then how they turn, which will be a forward signal in bear rallies, and why that is so important to you. If you're an investor or a trader, it doesn't matter. We're market makers. We do business a little different. But if I were you, if you're watching a video by chance, you would have to know how markets put in tops and how new bears start to make their move, just like you need to know how a bull puts in a long-term bottom and how a new bull rally takes itself to the top and then reverses into a bear that started in year 2000. And we've had a couple of great bull rallies within the longer-term bear, but once again, we're 11 years into the bear.